Imagine a world in monochrome. When we add colour, it enriches our perception of the world. In the world of investment, you'll limit your portfolio to be a drab monochrome if you stick to just buying single stocks. In this video, we'll introduce the multichrome world of asset allocation, which will help you build a portfolio that's better at surviving through the ups and downs of the global economy. I'm Roman, a financial educator working with Trading 212 to help you through your financial education. Please note that nothing in this video should be construed as financial advice. If you search for investments on Trading 212 and choose exchange traded funds, you'll see they're broken down into these categories. 4 of these are different asset types. That's equity, which are stock funds, real estate funds, which gives you large-scale commercial property investments, commodity funds, which are things like gold, oil, and agricultural products, and fixed income funds, which contain bonds. We'll go through each of these asset types to show how they can fit within a well-diversified portfolio. We can start with equity funds, which give you the ability to buy an off-the-shelf stock portfolio. Why not just choose single stocks? You could do this, but notice how if we look at 4 large and popular US stocks, although their prices do differ from one another, their broad behaviour is very similar. They all tumbled in 2020, then soared for the next 2 years and fell together in 2022. If you buy single stocks, it's as much a matter of luck as skill to choose those that perform best. It's a lot simpler to buy just one investment that gives you the large return of stocks while keeping the risk of unrecoverable crashes as low as possible. What kind of return can you expect for stocks versus bonds and commodities? This shows the return for the US stock market going back 150 years. The average US stock return has been over 9% over this period, and this would double your investment every 8 years. It wasn't a smooth ride, as this period spanned 2 world wars, 2 pandemics, periods of very high inflation, and deep recessions. But you can see that through all of that, stocks delivered good returns above inflation if you simply bought them and held them for a long time. Bonds returned less, around 5%, and gold returned a little bit more than inflation, which averaged just over 2%. If you want to buy a slice of all the stocks in the world, you can do that very easily on Trading 212 with these global stock ETFs. You'll see that the cheapest is an income fund, that's what DIST means, which pays you cash dividends into your account. I usually prefer accumulation funds because then I don't have to reinvest the dividends. But with the Pi feature in Trading 212, you can automatically reinvest your Pi dividends with a single click. You may be thinking that it makes no sense to hold bond funds because we saw that they've returned less than stock funds. That's certainly true over the long term, which is decades, but not everyone invests over the long term. If you mix stocks and bonds in a portfolio, that usually reduces the size of crashes in your portfolio because bonds are seen as a safe haven investment. When people are scared, they buy a type of bond called a government bond, and so these tend to cushion equity crashes. Look what happened in 2008 and 2009 while stocks were in meltdown. That's the red line. Bonds, in contrast, actually rallied. This hedge doesn't always work. For example, when inflation is high, both stocks and bonds sell off. But under normal circumstances, a mixture of stocks and bonds is less likely to crash, and this lets investors sleep better at night. Just as we could buy global stock funds that let us own a little bit of the largest stocks in the world, we can buy global bond funds that let us do the same thing for bonds. Here are 3 cheap global bond funds which are available on Trading 212. Again, notice that 2 of them are income funds that pay you some of the income generated by their bond portfolio, while the accumulation fund reinvests that dividend so that you don't have to. In the case of gold, we saw that it beat inflation slightly over the long term. That's generally true of other commodities too. Another way to look at commodities is how they behave when stock markets are falling. Gold is special in that it usually rallies when stocks are selling off, so it's called a safe haven investment. Some people include it in their portfolio for just this reason. Other commodities respond to rising global GDP growth, such as oil and industrial metals. These would be expected to fall during recessions and rise during recovery periods after a recession. Over 2022, it's interesting that energy provided one of the best ways to protect your portfolio from falling stock prices. This was because after the global reopening and due to geopolitical instability, demand for oil outstripped supply and led to a surge in energy prices. Here you can see the Nasdaq 100 tracker, EQQQ, and the broad commodity fund BCOG, which contains many commodities, including energy, alongside one another, showing how commodities could have offset some of the loss in US tech stocks. Here are two cheap commodity funds available on Trading 212. BCOG gives you exposure to a broad range of commodities, whereas SGLP is a gold fund that would sit in your portfolio as a hedge against equity market falls. Just remember that over the long term, commodities usually underperform stocks. Do you fancy being a property magnate? Well, now that's possible with a real estate investment trust. These are funds that allow you to earn income from commercial real estate. That would include office space, shopping malls, and apartment buildings. REITs have to pay a high proportion of their rental income to their investors and do so very tax efficiently. They also usually have capital gains, so the price of the fund rises too. But during recessions, be careful because REIT prices tend to fall. You've probably guessed that here too we can buy global REIT funds that give you exposure to a global portfolio of real estate. Here, for example, is the exposure for a fund from iShares, and you can see the country breakdown, which shows that the fund is globally diversified, which reduces your risk in the event that the property market in a single country falls sharply. Here are 3 global real estate funds available on Trading 212. Notice that the fees here tend to be higher as property is more expensive to manage and to buy and sell than stocks or bonds. These costs will be passed on to you in the management fee. REITs are usually bought by investors to provide some income, but also to diversify the stocks in a portfolio. I hope I've helped you to see the investment world in a bit more colour. By diversifying your portfolio and combining different asset types, your investment should be able to weather a wider range of economic conditions. Please click on like if you enjoyed this video, and do subscribe to the Trading 212 channel if you don't want to miss any new videos.